And we're back, episode 210, very special guest. We've got Matt Heine from, obviously, CEO of Netwealth. Netwealth has quite become one of Australia's greatest tech success stories. Matt joined the business back in 2001. You were, I think, employee number 5.
Indeed.
Which was pretty early. And I don't think you'd launched any products when you joined. So you pretty much joined it at the start. Obviously, your dad had founded it, but really it was almost a partnership between you two guys. Business eventually listed in December 2017. We'll talk a bit more about that later. Priced at $3.70 a share, giving it a market cap of $879 million. And it's since become one of the all-time greats. I think you hit a $10 billion valuation last year in the pre-SaaSpocalypse boom.
Very close, yes.
So you got very close to 10 billion, and it's currently worth more than $6 billion, which is actually incredible. You've been joint manager and director of the business since 2017 and sole MD and CEO for the last 3 years, or 4 years now almost. Welcome, Matt.
Thanks. Great to be here. Great to meet Adir, and long-term fanboy of the pod, as you know.
Likewise. So why don't you tell us a bit about the evolution of business? You started virtually day one, tiny business. You weren't in a garage, I guess, but what was it like in those early days?
Yeah, it's funny actually. I was just giving Adir a quick rundown of the start, and I sort of often joke that it's a classic startup story and that my old man started in his bedroom. It was just that the bedroom happened to be in Toorak. So, but it really was in many ways the classic startup. I joined as the 5th employee, as you mentioned. The old man had started the business about a year and a half beforehand.
And you were 22. You were pretty young at the time. Yeah.
And how old was your dad when he started?
He was 50. So
because he'd had an illustrious career before he started this business, correct? Like he'd done well at a variety of different things beforehand.
Yeah, he's done plenty of things. He's a classic serial entrepreneur, and he'd been through sort of trading businesses. At one point, he was making frozen dinners for Marks and Sparks over in the UK.
Is that right?
Got involved in radio stations.
That's right. What was a radio station?
So he did the roll up of Eon FM to Triple M.
That's right.
Back in the day.
Before I was
I didn't know that. Oh, that's right.
So he's done all sorts of interesting things, and just before starting Netwealth, he'd actually sold Heine Management, which was a listed and unlisted property company, and that's sort of really, I guess, part of our heritage as in financial services. He started his first unit trust and super fund back in 1983. Wow. So right back in the early days.
How cognizant were you of all this when you were a kid? Like my dad was a builder. I kind of knew what he did, but it's not this. This is big time. Like what was he? How much do you get involved as a kid with all this stuff?
It's a great question, and I'm trying maybe badly to do something similar with my children, and so my son's bought his first shares, which we can talk about his portfolio because it was actually a great portfolio that he picked, but we would talk about it a lot at the sort of the kitchen table. So he would come home and he was always very open about what was going on, and he went through some incredibly tough times, particularly in the 90s, and he didn't shy away from it and sort of wasn't overt, and it's not like all we talked about, but certainly we were very across what the business did, and he'd explain what he was doing. And I think I bought my first shares when I was 7, actually in a company called Heine.
I remember that company, a gold miner?
Correct, spot on. Gary Morgan.
That's the first time I've ever gotten something
Morgan's
before
company,
you.
Yeah.
Correct.
So I was trying to think of what company was. That's right.
Still looking for gold. And,
Still looking
and minerals
for gold. Now would be a good time to find gold.
Absolutely.
We've left their run late. And so when you talk about discussions at the dining table, were you very aware of the vagaries of business growing up and the way it's like feast and famine, a roller coaster? Was that, because a lot of people in business that run businesses, they'll often hide the suffering from their kids, I find.
Totally.
And so did you know how hard things were in business when you were growing up as a rule?
Probably didn't know the extent of sort of how tough things were, but
Mm.
things would happen, and you think, oh, that's a bit strange. Why are these people out the front of our house or whatever it might be? And at one point we were actually part of an armed robbery at home, which may or may not have been related. We still don't sort of necessarily know, but little things like that along the way. You think, okay, well maybe this is one of the good times or one of the bad times. But he certainly didn't hide the fact, and I think it was a really good education, and then you sort of just learn symbiotically. And to be honest, when I look at sort of my career, and people often ask, I think about mentors and things like that. I've been pretty lucky. I joke that, I've worked with Dad for 47 years, and the last 25 of them have been at Netwealth. But being able to sit next to him and learn from him, it wasn't sort of a formal process or formal mentorship, but you get to see how he operates, and that was with customers, it was with staff, and just how he went about business. And I think that was probably one of the best cadetships you could possibly hope for.
Because I personally think showing your kids the ups and downs, that is what drives resilience in them, because kids go through ups and downs and they look at their parents, let's say in this case dad, and they think, why has my life got all these downs in it? And like things seem to go so well for my dad. He nails things. And I think by showing, like I'm very transparent with my kids about the ups and downs. And I think that shows them that like everyone, it's not just them, everyone's going through these. And like if you're down, that's okay. You can bounce back up again. Like that is just the way life works.
Yeah, and absolutely. And we have a bit of a thing at home when we go around the table. I've got 3 very young kids or youngish now, and we talk about what was the best thing about your day, what made you laugh, and what was the worst thing about your day, and how did you deal with it. And I'm pretty sort of transparent, and it might be I had to let someone go today, and they'll ask a lot of questions about that, and then sometimes it's been a great day, and you can sort of talk about that as well. So it's good fun, and hopefully some of that rubs off on them as well.
Let's talk about the evolution of the business. So you started pre-product. What was the business sort of day one, and how has it changed? How did it change between 2001 and getting to listing to the mid-2010s?
Yeah, so it's changed obviously hugely. The product is far beyond, I think, what any of us had envisaged it could get to.
What did you envisage just at the start?
Yeah, so at the start, so it's 1999, peak of the sort of .com era, and that was really, I guess, the heritage as well of Netwealth. It was meant to be net wealth, but also internet wealth. And at the time, the logo had a dropped E, which was sort of a bit of a nod to Internet Explorer at the time, but it was also incredibly hard to use with anything. So my first job was actually to straighten up the E and get it in line with the other letters.
Didn't Enron have a wonky E as
exactly,
well?
Yeah, so that was it really was sort of peak.com. So we had, when I started, literally there was no products, it was sort of pretty colours on a spreadsheet. We had a service with a ComSec subsidiary, which was a discount online broker, and we were the cheapest online broker in Australia for many years at $9.99. And that was just a way to really build the brand and sort of try and get the name out there.
Was it under the Netwealth brand?
It was under the Netwealth brand.
I wonder why I don't remember that. Do you have a lot of customers?
We built up about 20 or 30,000 customers maybe.
Yeah.
And another funny story there, one of my many jobs was to create the banner ads to put onto 9MSN, so I would do them in Paint.
Of course.
Yeah, and
don't knock Paint.
No, it
I
was
used Paint in 2010 for our business.
And so you go onto 9MSN and they'd be all these fancy agency ads, and then there'd be my banner ads down the side in sort of Times New Roman or whatever it might have been. But it was a great way to sort of build the brand and build a bit of a customer base.
I reckon every other business advertising is now dead. So
exactly.
Clearly.
And then alongside that, we were building out a lot of pre-packaged investments. So the idea was, at a simplistic form, was to provide access to investors to buy investments online. So at the time, there was groups like InvestSmart and a number of sort of mail order investment companies where you'd sort of see something, you'd fill out a free entry form in the back of Money magazine, and they'd send you out a PDS. So we thought we can disrupt this.
InvestSmart is still going.
It is
They haven't
still
quite had they haven't quite had the Netwealth success, but Paul Clitheroe is the chairman of InvestSmart, who was the Money magazine guy that you just mentioned. So you've kind of outperformed all of these much bigger brands at the time that you started. If you roll forward 25 years, like your success has completely diminished all of these other businesses.
Which is
quite
classic
remarkable,
canvassing, right? You guys were the upstarts against all these big incumbents, and you've smashed all of them, really.
Yeah, and look, there was absolutely, we talk about luck, and I know you talk about luck on the show a lot. 2015, 17. We were growing reasonably well, but we were right product, right people, right place at the right time. There's no doubt with things like the Royal Commission, so we did get very lucky there. But our business pivoted from that sort of direct to consumer pretty early in the piece. We worked out that it was going to be really hard to grow that business, and Dad had worked with financial advisors for sort of a couple of decades through his previous business, and decided to build out the advisor offering. So
what year was this that you started building out advisory?
That would have been probably 2003, 2004.
So early,
so it was
really
pretty early.
But how big's a team at this point?
Oh, it would have been tiny, so less than 20.
Okay.
Maybe 25.
Yeah.
But we'd outsourced a lot of the technology build to a company in Perth. I think it might have been part of Sausage Software back then.
Oh, yeah.
God.
So
it's like
we're really going back.
Every blast from the past possible you were connected to.
So that was sort of part of that early piece. And then we had to work really hard. So it was a classic startup story. We had to go to customers. They would say, we love what you built there, but you don't have a super fund. So you go and build a super fund, and then you don't have insurance. So we'd have to build insurance. So for that first 5 years, we really had to pedal very quickly, take customer feedback and build the product out as quickly as possible.
Were you making money?
No, so it took us 63 months to hit our first $1 billion under management.
Yeah.
And it happened that was the point at which we also broke even for the first time.
Well, it's not that. 5 years is not crazy.
You don't ask the next question, which is how much cash do you need to pour into a loss-making business to get to month 63? That's the question.
Yeah, so it's quite a lot, which Dad used to tell the story. Sit around the table, the boardroom table, and for a long time, people used to call it investing. He would just call it losses. But for a long time there, we had invested more than we had under management, and so given the nature of our business, that was not a great position to be in.
Well, the net wealth is reducing my net wealth
Correct,
for the first
exactly.
60. But when you say, I won't probe you on the number, but it's presumably 8 figures that you have to invest into a business like this to get it to break even.
Yeah. So it was definitely, again, the technology was probably the biggest spend. We were actually talking about this the other day, and I think at the time the first quote we got was for $1 million, and none of us could believe it. Like, how can you possibly spend that much on technology and on a website?
What are you spending these days?
Well, it's mostly expensed, but close to half of our revenue is people, and 40% of that would be tech. So it's many multiples of that these days.
Not including the token avalanche
Correct.
that we're all paying for now.
Yeah.
And my other question on kind of the origins of this is, so your father is 50 years old or so. He's really done well in business. Lots of, I think, confused people think about retiring when that's their lot in life. But he decides he wants to go and do something that is not entirely different from what he's done previously, but pretty different, and go and pour all this money into it and do it again. Like, what do you think the motivation is there? Now that, you're not quite 50, but like, you kind of relate to the age a bit. Like, what do you think the motivation is there?
So I'm 47 now, so very close to 50, and there is no way that I would be retiring at 50.
Yeah, absolutely.
And I think, so they'd started to look at sort of platforms a little bit in the previous business, which was property, so it just didn't fit into what they were doing at the time. So all of the big banks had started going into this space on the advisor offering. So we were basically competing against Commonwealth Bank, Westpac, AMP, CBA, Macquarie. So a couple of small competitors to go up against with very deep pockets. And he doesn't play golf, and he's always said that work's his hobby. So I think he sort of retired literally for 2 weeks and was already working on what to do next. He sort of tried to be an investor for 15 seconds and realised that wasn't all it was cracked up to be. Had a couple of great investments and a couple of shockers. He was an early investor in Seek back in the day, so that was one of the good ones. Yeah. And there was a lot of other really bad ones.
He sold out in 2011, he ran amazingly well.
You only need one great investment. I think
correct.
9/10 of this country is powered by Canva, isn't it? So
still waiting for my Canva shares to come through.
So you got the business is coming along pretty nicely. It's like you break even at 2004, 2005, billion under management. This is going pretty well. GFC hits. I imagine that wouldn't have been ideal for you guys, given you sort of based largely on investor flows.
It was interesting. So it's going back a long time now, but it was obviously a really rough time in global markets. We were just starting to get pace, and there was a bit of a shift from financial advisors at the time to be leaving the banks and the institutions to go what they called independent, you're not allowed to use that word, but sort of non-bank, non-institution. And having left the banks and the institutions, there weren't actually many independent options for them to work with. So we were starting to get good sort of traction. Our business had grown quite a lot at that stage. The product was very, very broad. So it was more about we can work with you rather than telling you how to do your business. And that was resonating really strongly. So throughout the GFC, again, off a very small base, we were able to keep that momentum going and continue to sort of build the business.
So what was the product actually, to explain to people who have never
we should start with that, because if we were a professional podcast, we would start with...
We're a professional company now.
That's true. It can be very misleading.
First episode.
What you can say, they would usually say, what is it exactly that your business does? It did occur to me, we're building up to
the audience.
All right, you're building up to it.
Okay.
Grand plan. No, hit him with what the hell do you actually do for a living?
Partly because the business has changed somewhat over the years. So at this point, what are you doing for financial planners and financial advisors? I guess call it GFC, post GFC.
Yes, probably the easiest way to think about it is in the same way that accountants might use Xero to manage all of their customers and all of their work and their workflows. We do something similar for financial advisor and intermediary. So whether you're sort of a suburban financial planner, working in a private bank, broking firm, use our technology to effectively manage all of the portfolios for your customers. So that could be through our superannuation fund, where we're the trustee. Could be through our investment accounts, where you can manage SMSFs or trusts or companies. And through that service, you can buy and sell all of the assets for your customers. So it could be domestic shares, could be shares across 16 exchanges globally, could be managed funds, bonds, term deposits, private markets. And we make it really easy to do all of that at scale for financial advisors. We then do all the reporting, tax reporting, and provide sort of client access as well to clients' accounts. So It's a very sort of, I guess, broad offering, but makes it really easy for financial advisors. And I think you're a customer these
I'm a
days.
direct
Adam.
customer.
Or
Yeah,
direct
which is a little bit
customer.
different. We'll get to that in a
Direct
second.
customer.
Sometimes people talk in this world about wraps.
Yes, we're a wrap.
So which is effectively, I mean, it's a pretty basic kind of name, isn't it? It's like a wrapper that goes across the top of everything and lets people, instead of going and finding individual assets, access them all through a single platform. And you didn't invent the idea of a wrap, like that's been around for a long time. And so why was there space for you to do a wrap? Like, why is there opportunity in that market?
Yeah, well, there wasn't really.
There weren't really
There
wraps.
wasn't. There was like all the major banks and institutions were doing a really good job of it. They built up sort of platforms with $80 or $100 billion at the time. And I guess the difference to the market now versus back then was that the banks and institutions owned 80% of the advice. So if you're a financial advisor,
I see.
the banks typically were your employer, and they had maybe 5,000 or 6,000 advisors working for them. They were effectively distributing their platforms. So we saw an opportunity to service the non-bank advisor, which at the time was only 20% of the market, and really competitive. And
how many were there? Like, what was the TAM back in 2008?
It was a lot
2010?
bigger, and so it was probably about 20,000 advisors. A lot of sort of older advisors, life insurance advisors.
20,000 independent advisors or in total?
In total.
Right.
And
That's
now
including the banks. So it's 4,000. Your TAM was 4,000, 16,000 the banks.
Yeah, and now the number of advisors actually dropped to about 10,000.
Total.
But the TAM for us is probably 100%, and we're pushing into new
Oh,
markets.
so banks don't do it anymore.
Well, through the Royal Commission,
Oh,
they
they went
basically,
out,
through vertical
It's very
integration, it got
interesting.
too hard.
Because last week, or whatever, I lose track of time, as you know. At some point in the last 3 years, we've spoken about SiteMinder. I think it might have been last week or the week before.
Yeah, it was a week ago.
And so basically, SiteMinder,
7 days.
what I thought was interesting about SiteMinder is it's a platform that gives you access, that gives, online travel agents access to inventory from hotels, but they work only through probably these independent hotels, not these major hotels. And this story is kind of like a
Aussie
SiteMinder
company
except
taking on the world.
all
Yeah.
of the hotel groups dissolve, all the big groups, and suddenly the number of hotels halves, but the TAM goes to 100%. It kind of reminds
TAM
me of
tripled,
that.
even though
And so if I was running around, I'll ask you, I'll do the unpleasant questions. So if I was running around and saying, my TAM is 4,000 financial advisors. Like, that sounds terrible as a TAM, don't you think? Like,
Absolutely.
How was anyone interested in that?
It was a bit of a leap of faith, and I think we often joke about if you looked back on it, you probably wouldn't do it. It turned out all right, but yeah, it was a pretty big move at the time.
How many? So we'll talk about your private business in a second. But of the 4,000 advisors, how does that translate? Back then, how does that translate into end users? As in end,
How many customers would they have?
Yeah, it was a long time ago, and I don't think we actually calculated it, to be fair.
On average, what's the number? Has this changed over the years? As in each number of clients per advisor?
Yeah, so that's really our big opportunity now. So we talk about a number of different TAMs. If you look at our direct sort of space, which is the platform market, that's about $1.2 trillion, and that's growing at about 10% per annum. We've got 9.7% of that. And people often focus on that as being our TAM, but the reality is that it's much bigger than that.
This is financial planners.
This is correct. It's under management. Yeah, exactly.
So that's $100 billion you've got roughly.
We've got 125, and then we manage about another 30 billion in sort of directly through our various products. But the big opportunity for us is growing our market share within the direct market, so as in the platform market. But then industry funds are suddenly moving from accumulation into decumulation, and there's $1.8 trillion sitting in industry funds. 600 million of that remarkably sits in accounts over 500,000, which represents 4% of their membership. And they're the type of accounts that are actively seeking advisors and will more often than not move across to a product like ours. And that number just continues to grow.
10% growth seems low to me for that pool of funds. I tell you why it seems low. How much is super nowadays? 40% or something?
It's 12% of how much?
12%. I remember some huge...
12.5 now, maybe?
Whatever it is. It's going to end up to be 200% at some point, depending on the government.
Paul
and
Keating moves to 200 at will,
Yeah, agree with you. So 12% super. That's good for you.
Great.
And investment growth. And so how can 12% super plus investment growth only lead to a 10% growth each year in those funds under management. I don't understand
so
that.
that's just one part of the market, and that really relies on advisors bringing new money into the system as opposed to just the system growth.
Well, why is the system not growing by 15% by itself?
Yeah, so for a long time, post-Royal Commission, and this has now changed dramatically and it's actually accelerating in our favour, money was actually going out of the platform market, so away from financial advisors into industry funds.
Right.
And now what we're seeing is that trend has dramatically shifted, and there's some amazing charts online at the moment, which is the industry funds, all but Uni Super, are now in net outflow,
Right.
and all of the retail
So you've
funds.
got a tailwind powering
We've
your
got a huge
business at the
tailwind.
moment. And because basically the Royal Commission shredded the credibility of like wealth management largely, which I thought was counterproductive. I mean, I don't know, you can refute me on this, it's a while ago now, but I look at AMP today versus AMP before the Royal Commission.
Well, AMP's been on downward slopes.
It was, but
really.
they were crunched by the Royal Commission
the worst hit.
by far, apart from the bloke who collapsed and went to hospital.
Who was that? It was
I
one of the bank
forgot.
guys, wasn't it?
No,
it was one
he
of
ran
the
a private wealth business.
Oh, that's right.
Yeah. I don't think it was staged. I think he
Yeah,
was
no,
overwhelmed by the. Well, I don't think it wasn't his
that
finest
wasn't a good time
moments.
for the industry, that's for sure.
No, and so I look at that. I know this digresses slightly, but I look at this Royal Commission. Obviously, there's a Royal Commission going on at the moment into anti-Semitism. There's lots of Royal Commissions. I look at that effectively picking the, I would say, cleanest part of the financial services industry in a lot of ways, the retail part of the industry, and pummeling some companies, AMP almost into oblivion. When I look at it, it doesn't look like there's been a net benefit as a consequence of that Royal Commission. It looks like it's damaged some companies. When you look at the industry, it's a tricky question, probably a bit political for you to answer, but do you see a before and after in terms of the way the industry's run from the Royal Commission?
It's completely different.
Okay.
Yeah, it is. It completely reshaped the whole industry, both the players in it, but also the way that advice was provided and the guardrails that sit around advice. And advice is constantly in the press, and unfortunately there is often one or two bad actors that will do the wrong thing, and that tends to obviously then taint the whole industry. But there is, out of 10,000 great advisors, there's maybe half a dozen bad advisors that really do cast a long shadow over the industry. But the way that the industry functions and operates now is fundamentally different to what it was in 2017.
But when you look at it, I thought you got very unfairly maligned for this, what was it called, Guardian or whoever?
First Guardian.
First
This is
Guardian.
completely separate. This is 6 years post.
I agree, but
Yeah.
you look at something like that, which, what was it, effectively a huge fraud.
Yeah.
And you look at the fact that essentially they're complaining to wraps and platform
It
companies.
was Macquarie who got hit even harder than you guys, right?
Yes,
They were,
Macquarie
really
had
smashed.
a product called Shield, and there was a lot of commonality between the two, and we unfortunately had a fund on the platform called First Guardian. And as you say, it was a very sophisticated fraud that did get through our governance processes. There was a bit of a misconception that they said, can we go on the menu? And we said yes. There was 2 months of back and forward before that occurred. And the audited accounts had been signed off and no one had actually done the work. So there was a lot of just misinformation and fraudulent activity that went on there.
Did anything happen to the auditors here?
Not yet. So there's still huge
Who
amounts of
were
court
they? Do
cases.
you know who they were?
I can't remember now.
Yeah.
Trying to block it out of my mind.
But the reason I ask these questions is because it goes to where does this wrap kind of platform fit into the industry? And the thing is, I think you're going to like what I say here. So if you look at Facebook spends most of their life arguing we're a platform that facilitates
Section
people
230, right?
posting.
They protect. US publishers have protection.
That's right. They're not.
Social media get protected as a
They're
result
not
of this.
editorially responsible, and I would say, they've got various mechanisms for trying to filter out junk.
And there's a real argument they algorithmically enhance certain content, so they are should be far more liable than a rap platform.
That's right. They're probably, you would say, if you wanted to talk about editorially, to use a word, who's more responsible for the content on their platform, you would say Facebook is more responsible than a rap platform. But you do take steps to validate what goes onto your platform. So how do you think about this? Because it's a complicated issue, right? How do you think about this? There was no finding against you. There wasn't even a case against you. You effectively compensated customers voluntarily for a lot of money. I can't remember that. $100 million. How do you feel about the focus on reps being responsible for what's sitting on their platforms?
It's a great question. We've done a huge amount of soul searching over this, as has the industry. And I think there's two parts to our business. And the one where we decided to compensate members, and we often say it wasn't necessarily a fair outcome, but it was the right outcome. for a whole range of reasons. But as the trustee of the superannuation fund, we are putting trust to people's money. And at the end of the day, whilst we had very high governance standards, it really has sort of narrowed the focus on the fact that there are some really bad actors out there that are trying to take advantage of the $4 trillion that sits in superannuation. So I think for the superannuation product, where we are the trustee, moving forward, it's very clear what the obligations are, and we need to make sure that we're doing the work and that the funds that are available to our members are fit for purpose, and that we've done a huge amount of work both onboarding and also from a monitoring perspective to keep their money safe. When it comes to the investment account, there might be a slightly different take there, which is we're not the trustee, we're providing effectively an administration platform.
Like to Adam, for example.
Correct,
yeah.
Where we're saying, look, we want to open up and make it easy for you to invest globally, we want to make it easy for you to invest into private markets and local markets, and whilst we still obviously have an obligation there, the question is, do we actually want to be trying to restrict what people invest into in the same way that ComSec wouldn't necessarily say, look, you can buy that share, but not that share.
Where do you draw the line? Yeah, I don't think you should invest in corporate travel management last year because I think these guys dodgy. Well, lots of people did. Like, you're not.
And the ASX listed. Like, the ASX let them stay on the
auditors
ASX.
do it. The ASX do it. ASIC don't do anything. Like, it's.
Well,
I found this whole thing completely bizarre. I get the trustee argument, but.
Well, what about if we say, because that's a very good answer that you've given, and you're the CEO of a $6 billion ASX listed company, and so you're good at giving answers, and you're good at giving answers that is a very serious and responsible answer you've just given. And so I want to give a blunter answer that I would feel if I was in your shoes, which is every one of you, not including the direct category with Adam, which is these are smart people. Like, Adam's a smart guy, he's on your platform.
Debatable.
Forget about him. All of these other people, they've all got financial planners. Every one of them, that is how they access this platform. Every one of them is receiving advice from a financial planner. Every one of them is paying a financial planner for that advice. And somehow the platform, the tech platform that's being used, is responsible for the negative outcomes. It's tricky for you to comment, but that would be how I would feel in your shoes.
Yeah, it's fair to say that there's a lot of people involved in this, and there's a lot of breakdowns and a lot of bad actors, and they will hopefully be taken to task in the coming years.
And if you want to commit a fraud, in my experience, looking at the way things are done, it's almost impossible for someone to catch a fraud until people become too greedy or do something that's completely dumb.
Always easy in hindsight.
That's right.
Yeah. Well, I'd make the final argument is that what happened to moral hazard? If someone invests in whatever it is, whether it's a company, whether it's a fund, you've got to do your own research, whether you're being advised or not. Like, surely, why are we compensating people for making stupid decisions? At what point do you, like, how much can Australia turn into this socialist country, which is effectively what we've become, this welfare state?
Well, being defrauded is not necessarily making a stupid decision.
Yes, it is.
Why
Absolutely, because you put your money in someone who's a fraud.
Well,
absolutely, it is.
But you didn't know that.
You consciously made that decision to believe them.
You don't mean moral hazard. You more mean caveat emptor, right? Like, if you make a decision to
no, I mean moral hazard. You can make a bad decision and somebody else will pay for that loss.
I see what
Matt's business has lots of money. We'll go to the person who's got lots of
money.
money.
No, that is true. You're right about that.
It's just outrageous.
I agree with you. You're right.
And I'm almost guaranteed nothing will happen to the auditors because nothing ever happens to the auditors.
Well, Arthur Anderson ceased to exist.
So that was overturned. So nothing would have happened had they played out, and that was in the US, not Australia. So, and they all went to somewhere else. So every Australian auditor went to EY anyway. So actually, nothing happened to them. So what about every other collapse I wrote about in my book? Nothing happened to anybody. Yeah. Like, the only thing, it's only the good guys end up having to pay, and the bad guys just whistle off into the sunset. Anyway,
this whole podcast episode was so that Adam could spruik his book. By the way,
I didn't actually know about the book.
What do you think he wrote a book on? The dodgiest companies in Australian history. Correct?
No, it actually wasn't that. It was more corporate greed.
Pigs at the Trough. That's
Pigs
the
at
name.
the Trough.
You should buy his book.
You can actually.
It's in. I was going to make fun of him and say it's in the bargain bins at every bad bookstore.
It's not
but actually, it's a very good book. I can highly recommend it, and you should pay full price for it.
Well, you have to. When I tried to get them to discount, they wouldn't. Anyway,
it's not part of my Amazon Kindle bundle.
No, it's not actually. Sadly, let's go back to the business. I want to go back to IPO time. So 2016, 17, you guys done pretty well. And you decided to list. I presume you had other options at the time. You didn't. You could. Like, I'm sure PE would have loved this business. Why did you guys list?
It's a really interesting story. So it was around 2015. So we had never actually raised any external capital. So the only money in the business was our families. And my uncle, who had about 40% of the business at that time, and his family were passive investors, hadn't been involved in the business and were looking for liquidity. And at the time, I think we were around probably 10 or 12 billion under management. So we were making reasonable money. Things were certainly heading in the right direction.
How should people think about the margin you make, the profit margin on 10 or 12 mil, or like the revenue margin and the profit margin on 10 or 12 billion of funds under management?
Yeah, so remarkably, over the years, our margins, sort of discounting maybe the very early days, we earn about 50% EBITDA margin. So depending on the revenue, it's a great margin, and that's despite sort of pricing coming down very, very significantly over.
But that's
that
off your revenue, not off
our
GTV,
revenue.
not off FUM.
So now if you're looking at FUM, we earn on average about 32 basis points.
Okay.
Yeah, across all of the various ancillaries.
So you're a very good value platform for your user. Basically paying nothing,
it's
essentially.
incredibly cost effective.
Yeah.
And the bigger the account, which you might hate, the lower your fee.
That makes sense. Yeah.
So whatever someone's got under management, on average, you take 0.32% as the platform, and anything else they're paying to the advisor or whoever is offering product. Like the platform's very low.
Right. Yeah, absolutely. So we were growing nicely at the point, and my uncle was looking for some liquidity, and we were pretty determined not to go down the listing path, actually. Dad had been listed previously through Heine management, saying the trials and tribulations of that. And so we started talking to personal investors. They were somewhat sort of interested, but didn't want to pay the price that we were asking at the time.
What was your profitability like at the time?
I couldn't tell you.
I have to dig out the prospectus when we finish up.
Yeah, exactly. Yeah. And so we sort of put a line through private investors, interesting conversations, but just not for us. Met with a number of private equity firms, some of the sort of bigger ones as well as the smaller ones. And it became pretty apparent pretty quickly that, whilst they were probably closer to the price that we wanted, we weren't ready to relinquish control, and it would have sent out.
So they only want to control these PE firms.
So even as a partial investor, it was going to change the way that we did business, and Dad and I saw a really long runway for the business, and we're far from ready to relinquish that control. And it also just sent out a really bad signal to our investors, which is, we'd been in the market talking to the market about the fact that we're long-term investors, and in many ways back in the early days, they were sort of investing alongside us because they saw the values of the company and liked working with us. So to then say we're selling half the business or whatever it might have been, and we're going to sell the whole business in 5 to 7 years, it just was the wrong message and didn't work for us. So Tim Anthony, who was on our board at the time,
it's Village Roadshow,
correct? Yep.
UBS. Tim Anthony,
yeah, exactly right.
So he's going to be the inaugural chairman of Catch as well, but obviously never listed. Yeah.
So he was on our board, and he was previously very senior at UBS. And he said, "Look, I know it's not your preferred option, but why don't you just go and speak to a couple of the investment banks and just listen to what they have to say about the listing." And so we did. And as we sort of walked through that, we sort of came to the point that actually this is exactly what we should be doing, because it allows us to retain control. So we're only selling a small amount into the float. I think it was 15 or 20%. We were our family, so Dad and our side of the family didn't sell anything into the float. It sent the message that we were in this for the long term. And one of the byproducts of it that we hadn't actually anticipated was that when we actually did list, and it was obviously quite a successful listing, the brand awareness that it gave us was significant. And going from a privately owned, family-run business to a listed entity suddenly opened up a whole lot of doors that historically had been firmly shut to us, and we were able to go and work with the major banks and the major institutions and private wealth firms who historically just couldn't work with us from a procurement perspective. So a lot of really great things occurred off the back of it. And I think the other interesting point is, because of the nature of our business, when we're out there on the road shows, and Adir, you know this, you sort of do 200 or 300 meetings with fund managers. We knew a lot of them because we were already working with them on the platform. And so it was very familiar space, very familiar conversations that we were having. And because we were already regulated by pretty much everyone in Australia, going from a unlisted company to a listed company, I think we set up one new committee, which was the communications committee, which has subsequently been closed down and folded. So it really wasn't a big step up for us to actually get to a listing. And, whilst, again, you have your ups and your downs, I think on balance has been a fantastic outcome for us.
How has the business changed since listing? It's obviously grown a lot, but in terms of your day-to-day, the scale of the business, it's a pretty massive business now. What's been the day-to-day impact on
How many staff are there?
So we're just shy of 1,000 now.
1,000.
So it's
and when you listed, how big?
So we're 15 billion, so I'm guessing we're probably about 100 maybe.
Okay, so massive difference. So 10x the staff.
10x the staff.
And pretty much 10x the valuation as well, roughly.
And also just the business is probably 10 times the size as well in a pretty short period of time. So how does my day change? I spend a bit more time talking to investors and fund managers, but it really hasn't changed a lot. So the discipline was always there. One of the interesting things is that when you list, you do get sucked into quarterly results, and there's a lot of focus on what's the flows, and it's actually not a bad discipline to have. But you also have to often sit back and just ask the question: if we weren't listed, is this the decision we would be making?
Absolutely.
And if the answer is no, then you probably need to go back and really sort of stress test that idea a bit better. But look, I think there's a huge amount of benefits to being listed, but equally, you do need to be very mindful of all the things that investors are looking for.
How much of the company is controlled around the board table?
So it's still largely family owned. So our family owns about 47% still, and then it's institutions. Our board members have all got a small amount or an amount.
So that's why you can make the decisions that you make. This is one of the challenges, right? Adam will jump on this hard, I suspect. But effectively, when you've got a company that's owned by institutional investors with an entire board of independent non-executive directors, the pressure to make decisions that is in the short-term interest of shareholders is completely different to owning 47% of a company. And so it was kind of the Jerry Harvey argument in some ways, right? Which is, you can say whatever you want, be here, don't be here, it's up to you, but it's effectively a listed family business, and we're going to run it
as well, essentially.
What's that?
News Corp.
News Corp, we're going to run it our way as founders for long-term value creation, and you can decide if you want to get on that train or not. But the level of pressure is totally different. Have you sold down shares since IPO? Yes, presumably.
So we've sold down a small amount, but obviously we've still got a huge shareholding.
No,
so just by the way, that our shareholders still give us a hard time. It's not all plain sailing.
Well, I'm not shocked to hear that. I'm not shocked to hear that. But I will. This is my question about selling down. It wasn't like obviously not a gotcha of selling down. But in Australia, I think it's very problematic for founding shareholders to sell down because. You sell one share and you have to disclose it to the market with formal announcements, and everyone says the words negative signal, red flag, use whatever words you want. What does he know that we don't know? I mean, do you have that kind of experience? How do you feel about that part of being listed? Because they say liquidity, but it's kind of liquidity for everyone except you.
Absolutely, and we haven't sold down very much at all. So, and often it's like, well, if we sell now, what's the market going to think? The other problem is that there's usually something going on in the business, and it could be regulatory, it could be growth targets. We might get close to a quarterly.
So you're in blackout.
You're in blackout, and so we don't.
You guys pay pretty good dividends anyway, so it's not as if there's no liquidity coming out. Correct. Any shareholder.
Well, it's still. I mean, given the multiple of the company, the dividend yields about 1.5 or 2%. So it's certainly not a yield stock.
It's not bad. It's a pretty decent dividend for a business of your profitability.
But you're often in blackout. So the ability to sell down is very limited.
And what do you think about the US approach? Adam is a huge fan of the sell down of the Atlassian guys over time, and so
I am actually.
I know. I'm not. It sounds sarcastic, but
I assumed as much.
You think that they have sold at the right time?
Well, they stopped selling
when the share price went down.
Got to intrinsic value.
But they can sell on the basis of putting in an order, to sell down a certain number of shares every single day, and they're not affected by blackouts or because they're not reacting to short-term information. What do you think about a system like that for the ASX?
For the ASX, or for us, so we're classic entrepreneurs.
For you / for the ASX, bringing that kind of system in.
If you wanted to participate.
Yeah.
Should the ASX adopt this NASDAQ policy?
Possibly, but I think for us, we're classic entrepreneurs. We believe in our own BS, and we see huge upside in the company. And
you've been right so far.
And so far, it's been a really good call. But you look at it and say, okay, well, if I had this money today, what am I going to do with it? What would I invest into that is as good or we know as well as this company? And so that sort of forced sell down, I think it would probably be great because you say, well, hang on, why am I selling down now when we're really excited about what's coming or what's happening in the future?
You're in an unusual position. If I can, I'm a blunt guy. Most founders that build very valuable businesses don't have a lot of family wealth sitting outside the business they've created, and so their need to sell down and diversify and get access to liquidity is higher, right? And definitely Scott Farquhar. His wealth came from Atlassian. That's where his wealth came from. And so my issue is more with those kind of people, and his ability to sell down in the US without people calling it negative signals was completely different to an IPO in Australia.
Really, really clever, and it avoids a lot of the problems you just raised, which is, and I don't think that needs to be the ASX or the NASDAQ. I think if a founder comes out and says, here's what my divestment program's going to be.
Well, you can't, obviously blackouts stop you doing it in Australia.
And so you need to make sure that around blackouts, but I think it's pretty sensible. And the same thing happens when you're vesting shares, or you end up with these problems. So can we actually vest these shares now if we're in blackout? What do the rules actually mean? Because there's a lot of grey areas there.
Yeah. How do you think about profit growth versus revenue growth? Because there's obviously you guys are a profitable business, but you could be more profitable if you're willing to grow. You got a pretty high rule of 40, right?
So
60, 70 or
last
something?
year was close to 70.
Yeah, which is one of the highest on the ASX.
Absolutely.
Close to the highest.
Every
on the
Goldman
ASX.
Sachs document I get always has
Harvard,
the top
you guys,
right.
yeah,
Top right.
and Pro Medicus, it's and
Yeah.
Adir, I think's up there. But how do you guys balance profitability and revenue growth?
Yeah, it's a good question. That's probably the biggest debate that we have almost on a daily basis, which is, how do we keep going as fast as we want to go, but also make sure that we maintain really close financial discipline? And it's kind of silly when we're having our discussions or debates with shareholders, and going back to them giving us a hard time. Is our margin 50% or 49 or 48? It doesn't actually really matter in the long term when you're growing at 20% plus. And we look at it now, and I talked about the TAM being, we're probably like sub 1% when you really look at our actual market share. What a great opportunity to be investing in growth for what is one of the greatest opportunities I think we're going to see in a lifetime.
The fact that you're a dividend payer, irrespective of any other metrics about your business, my guess is post these legislated tax changes, your share price is going up and your yield is going down because people are going to skew so heavily towards dividend payers. I think you'll be a beneficiary of
Don't
that.
trigger me with this stuff.
What's that?
Don't trigger me with this
Don't
stuff.
trigger
Yeah,
me.
well, that is
I was
probably
hoping we
what's-
might avoid this
Well, that's
conversation.
probably what's going to happen, right? I mean,
absolutely.
Probably the share price will rise and the yield will fall because people will chase. I mean, how many stocks are there on the ASX? We can get a couple of percent. You're fully franked, presumably. So a couple of percent fully franked yield with
growth
20%
with
growth,
growth
in the
as
top.
well.
I
Yeah.
mean, it's
But,
not.
why
it's
the
not-
share
is
price
the
is
income
so
going to be
big.
enough? That's the question, because there's a lot of shares out there that are producing 5-10% income. But I prefer growth. I think longer term, if you can grow it, compound at 20-25%, what a fantastic business.
I would always, within reason, a profitable business, like genuinely profitable like you, that has growth potential north of 10%, you're north of 20, I would always skew more heavily towards growth, because if you play out the numbers, presuming that you can actually leverage the economic value of that growth down the track, you can't compare the trajectories of those two numbers over the long term. It's pretty straightforward.
And I think the reality is that it's not going to happen this year, but in future years, you look at the efficiency that AI is going to create, and you'll be able to start to really widen those jaws in time. And it's not necessarily about cost out, it's about how do we flatten headcount growth to really start to accelerate that profitability and keep growing at the rate that we are.
So what do you think your kind of, I'm sure you got asked this 100 times, but like what are the key barriers to AI producing a strong competitor to you?
Funnily enough, it's regulatory.
I agree with you
Yeah,
entirely.
so
That's the best barrier.
It's the best. It is almost
Decent barrier.
impossible for a new entrant to come into this market now. So if you look at the superannuation part of our business, where you're required to have a trustee license, APRA is not handing out new trustee licenses. And if anything, they're trying to consolidate the number of trustee licenses in Australia. And that makes it near enough impossible particularly for an offshore company to come into Australia, but also for a local one. You then look at a whole range of things. So for a new entrant to come in, they'd need to jump over all the regulatory barriers. So we're talking AML, KYC, superannuation trustees, ASIC licenses, the list goes on. They need to be able to come in at a price point that we are, so call it 32 basis points or below. Yeah. They need to be able to grow relationships for 4,000 plus advisors.
Well, that's another huge barrier. I think
Correct.
the price barrier is you can always run at a low price if you're willing to fund losses,
You
but
can.
getting the relationships is very hard.
And then you need to be able to make enough money in time to invest at the same rate that we're able to.
Yeah.
And so it's a pretty
Well,
difficult
I
equation
think
to
the
crack.
way you explain it is you've got a lot of powers when you talk about Hamilton Helmer. You guys almost have every single power,
Well,
which
I'll
is
give you the
Network
pretty
I'm
rare.
struggling with, but I'm hoping you can give me the answer.
Well, I'll give you the cornered resource because that's the regulatory.
That's the
regulatory,
advantage
yeah.
that you've got.
Well,
So
it's clearly Scale Corner Resource brand essentially as part of that.
yeah, network is not easy.
Process power's a bit
Adam
tricky,
always
but
comes up with a shaky network answer.
I know. I was hoping that you come up with
I
something
think there
creative.
probably is an element of network in that the more people on the platform, the more products want to go on your platform, which means it's better for the people on the platform. So I think there is
I think it's probably more of a flywheel. So the more customers, the more advisors,
Yep.
the more that we can invest into the tech, which creates an opportunity.
So you've got your Scale and network
Yeah.
almost always
But
crossover.
But I agree with your point. But probably you had a network effect in the early days as you were scaling. But then you've got the Uber effect, which is once you reach a certain size, every additional customer probably doesn't make much of a difference. Anyone who wants distribution is going to go and see you now as it
But same
is.
as brand power. Brand power is a legacy. Network can also be a legacy power. And you don't have
Yes,
to.
I
It's
think
not
it's a
always a
legacy
forward-looking
power.
power
That's
versus like a
right.
counter position.
I mean, over time, if we can, we'll try and build our own sort of sort of market where if you can actually create sort of liquidity for private markets or some of those different things, then network absolutely
Become a market maker on top of that. But even without that, which that'd be super cool, but even without that, I still feel you've got definitely scale, but I think probably network on top of that to a degree. Because if me and Adir are on there, talking your direct part of the business, if you've got more and more like those startup, when I got my startup stuff on, it was a real hassle because you had to speak to them and there's a whole project. But once you've got that once, for me, and Adir buys shares in the same business, it becomes a lot easier. So because you've got the relationship, you can add. I've done it before, so I think there is definitely a non-weak network. So you've got almost every power, which is why investors love you guys so much, because it's such a defensible business, almost impossible to beat.
I should come on the pod more often. I'm feeling great about this.
Can I ask you a couple of AI questions before I drink hemlock if I ask any more than that? So you're a non-hype CEO is how I would describe you. Like, you're not jumping on all of this, the hype machine of AI, but obviously you've got 1,000 staff and everyone across the world is making all of these pronouncements about staff reductions on the back of AI. How do you think about that from a CEO point of view, like the effect of AI on your staffing?
Yeah, so we've obviously looking at rolling out a number of different AI programs across the business. No surprises there. We're in that sort of nice phase where, because we are growing and we're expanding the product set, we're constantly needing people.
Yep.
And so the point at which, and this is happening on a daily basis, that we can actually automate a process or find efficiency somewhere in the business as a result of AI, we're able to move those people onto the next thing. And so at the moment, it's really not about, as I mentioned before, it's not about cost out.
Yep.
This is really about how do we flatten the growth of headcount, so we're not having to hire however many people it is every year.
So your staff can sleep well at night because you have no cost out program on the back of AI. And I think that, I find that discussion a bit interesting.
It's a reduction in cost in, which is the same with what we have.
Yes.
Yeah, we just haven't really grown our team much, but we're able to double revenue. I think you guys are almost identical in terms of just being able to.
You think you can keep your headcount? I'm talking to Adam on this one. Do you think you can get your headcount flat?
Well, we have over the last 2 years, but especially if you look at customer service, which is usually scales almost linearly with sales, because you have and
you put that down to AI that you've been able to keep afloat.
Chatbots and Sierra and all that kind of stuff for sure.
Tech team.
How much scaled a little bit, but maybe tech team's grown 25-30% in the last couple of years.
How about you, Matt?
Yeah, so the tech team's growing hugely at the moment. So the tech team's round figures, including product, probably around 400 now. And so the way that we're thinking about it, and this is what gets me really excited, is that if we can get, and we think we can, over the next 12 to 18 months, 30% efficiency out of the team. So that's not only utilising all the new sort of AI tooling, but it's actually fundamentally changing how we build product from idea and conception through to development and deployment. We can get the equivalent of having another 100 engineers effectively.
Pretty amazing.
And what we want to do is to drive efficiency, so make sure that we can get efficiency in customer service, efficiency in the admin, take that headcount that we would normally put into sort of processing and put that into the product and tech team, and really continue to accelerate that, because that's where we're going to get the biggest benefit.
Increase
from AI.
the moat.
And how much of your week is spent thinking about AI and talking about AI, and how much of your board meetings are spent thinking and talking about AI?
So it's probably about 6 hours a day would be talking about AI, I think, at the moment.
Really?
I love it. And I'm a product guy at heart. I love product. And I'm loving just where this is all heading. So spending a lot of time with our CTO, with our tech team, spend a huge amount of time, maybe they prefer I didn't, with the product team, just thinking about, how does this impact the customer experience? How does this impact our experience? How are we using this better in customer service? The board is certainly really actively engaged in the conversation and working with us. But at the end of the day, it's up to me and the executive team and the whole business to really be driving that forward.
And my last question is, the cost people talk about, I find the staff cost bit a bit boring, because we just discussed it here. There's efficiency tools. It's going to play out the way it plays out. But the emerging reality is the cost of infrastructure and tokens. Now, you don't have to worry so much about infrastructure. You're not building models, but you do have to worry about tokens. And so have you started thinking about the cost of tokens to your business and putting guidelines? Where are you at with thinking about tokens?
So I'm still getting over the shock of just our Azure bills and how quickly they're growing at the moment. Now we're having to focus on tokens as well. You might have seen the memes going around the internet at the moment. I've started hiring junior developers again because my token count's too much.
Yeah.
So sort of doing this full circle.
Yep.
So I think it's so much, it's so early in the journey that this is now something we're all grappling with. We've recently implemented Workday into the business from an HRIS system, and they've given us access to all of their new AI tools. But that first 3 months is actually about, look at how your staff are using it. Here's the dashboard that shows you how many tokens you're burning, and that'll give you an opportunity to sort of work out how broadly or not you actually roll this out. And as we sort of work through this sort of new way of working from a tech perspective, it's one of the things that we just have to be right on top of. I think it was Uber that spent $500,000, $500 million or something ridiculous on tokens.
60 million a day or something like that. That was in a month.
They use their whole token count in the space of 4 weeks.
Do you think you're going to be spending millions of dollars a year in the short term on tokens?
Haven't looked at it and probably couldn't comment on that.
Oh, easily. We're spending annualized at 3 million plus on AI, and we're a much smaller team than you.
AI just on the usage part of AI, effectively.
So effectively, we call it tokens, but they call it utilize.
But there's also, there's lazy development still with AI. So there's different ways that you can code that'll use 1/50th of the number of tokens. So I think that's really where the focus needs to be, which is this is where it's going. It's happening really quickly. We're going to get the benefit, but let's not make sure that we're just using it as a.
We know Claude's double to 5x the cost of most others. So you're paying that Claude brand premium.
Yes, that's true. But
do you? An immediate way to reduce it.
Is most of your either one of you can answer this? Is most of your token usage from the actual, I'm going to say, machines that you've built, agents, etc., using the tokens, or from people inside your organisations using AI? Developers.
Yeah. It's not agents. It's not open Claude.
Not yet.
So it's developers in their day-to-day jobs using whatever models they're using, probably Claude, Cursor as assisting tools for them to do their development work. I think that is ultimately what is going to limit the utilisation of AI. The token costs are becoming crazy.
Yeah, but if you look at, you're spending more, but we would spend, I'm trying to think how much we'd spend on developers. I call it 30 to 40 million a year, whatever it is. So it's still a fraction of that cost.
10% of your cost. Yeah,
exactly. Well, maybe even less, but yeah.
But what happens, and I haven't started thinking too much about this, what happens when you hit your token count and the developers can't develop?
Well, you know what happens.
You have to keep paying.
Well, the spend goes up. My guess is that...
Well, you find ways. You start using cheaper products, essentially. Lightweight products.
I think more and more people are going to take open source models and start...
On-prem.
Yeah, and start and probably the really good businesses like I'm guessing your business will do some retraining of open source models so it becomes more tailored towards your particular needs. Totally. I think that's where AI is going.
But again, I think cloud and we talked about the Azure cost before. It's going to follow almost exactly the same path. Where having moved everything to cloud, people are now saying, well, maybe a hybrid is the better way to go, and I'll actually bring my tech back on shore and put it in the office.
The thing is a vicious cycle because AI costs drive cloud costs.
Yeah,
correct.
And so you can't avoid it, right?
Microsoft's the winner.
Yeah. I think we'll have to call it a day. That was amazing, Matt. Congratulations on the business, which has been one of Australia's most incredible businesses, and you've been there since day one. Thank you, Matt. It's been great having you on, and look forward to getting you back on soon.
Look forward to it. Thanks.
Thanks, Matt.